The 21 crypto investing rules. These are rules I have learned and have stuck with me from traditional finance into crypto investing and have helped me build a sustainable and pragmatic, fast-growing portfolio. If you're able to internalize and act upon these, you're going to be well on your way to building meaningful wealth in crypto. First up, avoid FUD and FOMO. These are two psychological traits and phenomenon which really will hinder your growth in cryptocurrency. Oftentimes when you're chasing a hype, you're too late. Step number 2, think long term. Guess what? Most people actually can't. They're so busy chasing instant gratification and the next 1000x gem that just by you having a slightly longer time horizon, you already have the advantage. You're going to be on the opposite side of that greed and FOMO. Rule number 3, actually do some first-hand research. Now, of course, there's no harm in watching YouTube videos, in reading other people's reports, but actually doing your own first-hand research into your favorite projects is definitely going to put you head and shoulders amongst other investors. Rule number 4, and a huge mistake I see a lot of investors making, is they focus on the price and not the market cap. A mature investor understands that the value is shown by the market cap and not the price. The price is just a misnomer. Rule number 5 and 1 you've definitely heard about: not your keys, not your crypto. Basic principle, which you'll hear in some of these other rules, which is to focus on preserving your capital. If you cannot take care of the capital you already have, you have very little chance of growing your portfolio. So your first thing should be protecting your coins, cold storage. And that leads me on to rule number 6, and that is to preserve your capital. Any serious investor, first and foremost, no matter how little their portfolio is, they're focused on preserving their capital. The only worst thing than not growing your portfolio is seeing it decline. If you've got a $1,000 portfolio or $10,000 portfolio, and throughout the year that has declined, that is even worse than you getting a 1-2%. So don't, in your hunger to chase 10x returns, end up with a portfolio which has actually shrunk over time. Rule number 7, buy low and sell high. It sounds so basic, but I see so many new crypto investors chasing pumps and somehow selling dumps when they panic. Do not fall for that. You should be buying from positions of strength, often when the market is fearful, and looking to sell when you see that greed and FOMO, which we spoke about in rule number 1, start to creep back in. Crypto investing rule number 8, and that is to eat your veg. This is something we speak a lot about on the channel, and that is not to neglect the big anchors in your portfolio. It's so exciting to chase the next 1000x gem and these low cap altcoins which can 1000x overnight from here, but focus on eating your vegetables. These are going to be the anchors in your portfolio which will help you when there's a stormy day. Rule number 9, do not invest more than you're willing to lose. Now, a lot of people will be listening to this and saying, duh, but here's the reality. A lot of crypto investors and traders trade on margin, and the definition of margin is you cannot afford to lose that money. Moreover, if you're investing money which you need for rent in a few months' time, guess what? Your psychological disposition is gonna panic, and it's gonna lead you to making the wrong investment decisions. You need to be able to detach your emotions, as we're gonna talk about a little bit later. Rule number 10, and this one has stood the test of time, and that is only invest in things you understand. The number of crypto traders I see chasing the next hype and the next opportunity, they're buying cryptocurrencies where if I ask them for more than a sentence of what that project or that crypto does, they could not answer. Holding a project which you understand will help you navigate the FUD when somebody puts a negative article about your crypto you hold, will prevent you from panic selling and help you have conviction, which will allow you to hold during the tough times. Rule number 11, and this one's a little bit counterintuitive, but you don't need to win every single trade. This took me a while to learn. I actually learned it when I was trading at a major investment bank. The best trader on the entire floor, which all the hedge funds wanted to headhunt, he would not get every single trade right. In fact, he'd even get more than half of his trades wrong. But we're going to come on to risk management and how important that is. But the rule here is you do not need to get every trade right. And the other end of that spectrum is provided by rule number 12, which is just because you got lucky, it does not mean your strategy was right. Yes, there are so many people that have jumped in on a project, they've done 100x and made a lot of money. But guess what? So do people who win the lottery. It doesn't mean your strategy was right or that you even had a strategy to begin with. So what serious pragmatic investors do is they look for a repeatable process that will allow them to build wealth pragmatically, predictably, and sustainably over time. I'm not just looking for a lucky punt. You want to become a good boxer. Rule number 13, you want to avoid those pesky scams. Yes, those people looking to leech from your portfolio. As a basic rule, if you're building your house, make sure the front door is closed. Rule number 14, I've seen so many investors finding the perfect investment or entering the perfect trade only to be panicked out. You need to learn how to manage your emotions. Not being able to manage your emotions is the quickest way to disrupt winning positions. And rule number 15 is going to help you manage your emotions, and that is by managing your risk. This is a very foreign concept, particularly to new traders here who have just jumped into crypto looking to make a quick buck. But you need to make sure only a certain percentage of your portfolio is risked on any one given trade or any one given project in your long-term portfolio. I know so many people who have 50, 60% of their portfolio in one low-cap altcoin. That is not a way to build pragmatic, sustainable wealth in crypto. You should be allocating 1%, 2%, maximum maybe 3% to any given project, unless it's one of the big caps. Rule number 16, and this ties in with the need not to win every trade, and that is you do not need to identify every winning crypto project. In fact, it's impossible. So many people jump out and say, oh, you missed this coin, you missed this project. Ignore those people. As long as the projects you invest in, you have conviction in, you know detailed what they're working on, why you believe in the project, why you think they're going to grow from here, that's all that matters. There will inevitably be projects you miss that do a 10x, 100x, 1000x, but that's okay. You need to focus on your area of competence and the projects which you have conviction in. You cannot borrow conviction from somebody else. Rule number 17 is a quick way I'm able to identify a seasoned investor versus somebody who's just started investing, and that is a seasoned investor will think in terms of a portfolio. When they speak about their investments, they have a picture of their portfolio currently, what they want it to look like, and that portfolio is divided into narratives. So they will say, I want this percentage in Bitcoin, I want this percentage in layer 1 solutions, I want this percentage in gaming, this percentage in NFTs. But somebody who's new to crypto, who doesn't have that level of thinking, will just have a random bag of altcoins which they've managed to accumulate, most times than not, just through FUD and hype. Rule number 18 really did help me build my initial mass of crypto wealth. As you guys know, I was originally in traditional finance, and I take crypto seriously and not seriously over time as it was maturing. But one thing I did do early on was continually buy recurring purchases. So I decided I was gonna set at least 1% of my entire net worth into crypto many years ago, and I would just dollar cost average these amounts using a recurring buy feature which you can buy on an exchange. So definitely consider automating some of your purchases, because it's going to free up your bandwidth to do more research on other great projects. Rule number 19, and again another basic one, but you'll be shocked and dismayed at how many people neglect this one once their emotions take over. And that is to diversify your portfolio. I know so many crypto investors who are so deep in the Phantom ecosystem, so deep in the Solana ecosystem or the Ethereum ecosystem. A seasoned investor is able to park their emotions. Maybe they do subconsciously have a favorite, but their portfolio will not show you that. It's diverse. They're willing to lose any given project. If that project collapsed like Terra Luna did, they would be just fine. They're not all in on any one narrative. It's a diversified portfolio that can stand the test of time. Rule number 20, and that is to diversify your exchanges. Now, many years ago, I used to word this as diversify your banks, because we know from the 2008 crisis when Lehman Brothers collapsed that any given bank can collapse. Well, the modern crypto version of that is that any given exchange can collapse. And we've seen in 2022 with the famous collapse of FTX, we cannot have all our funds tied into any one given exchange. And last but not least, rule number 21, and that is to never go all in. The number of crypto investors, and probably some of us YouTubers are to blame for it as well, just say we're going to go all in. Now, what does that mean? Well, going all in could innocently just mean I'm ready to buy the dip now and add to my positions at this level. But the reality is there are so many crypto investors that literally do go all in like it's a poker table, and they go and put 100% of their portfolio into some low cap gem. That is the quickest way to get wrecked. invest, diversify, build your portfolio over time, DCA, and actually think like a professional. So there you have it, guys. 21 rules of crypto investing I live by to make sure I can build and maintain and preserve sustainable, pragmatic wealth in crypto. I know that might not be attractive. Some people just want to quickly 1000x overnight, but guess what? Easy come, easy go. You can just do a sample of lottery winners to see how long they're able to hold their net worth. And guess what? They're not able to. So instead, learn to elevate your ability to invest, not just in crypto, but in any asset class. Learn to build a portfolio, follow these 21 rules, and you'll definitely make really solid progress towards building the crypto portfolio you desire. Hope you guys enjoyed this video. Don't forget to go watch this video here where I outline 5 crypto side hustles you can build extra side income with if you want more streams of income to add to your diversified portfolio. Thanks for watching, guys, and I'll see you in the next one.